Brokers Are Better community. We have Barry Habib here. Obviously, a lot going on coming out of last week. A lot of conversations about Ginnie Mae's efforts to provide some relief. Barry's going to share some updates for us on both the current market and just what he's hearing from different participants in the market. Barry, how are you?
I'm great, Anthony. I'm great. Healthy, thank goodness. Hope all of you are healthy. You look great. People watching, I hope you're safe, and healthy, and feeling good.
So let's kick it off. I shared a video with everybody this morning on my Facebook feed from Steve Leisman this morning during opening. I think it was their opening bell segment on CNBC, and the conversation was about a letter that the Fed received from the Mortgage Bankers Association urging them to slow down MBS purchases.
Actually, the MBA was taking a different approach. They wanted some relief from Ginnie. And we have been kind of carrying the torch on, hey, the solution to the acute problem, which are these margin calls, is something that we've been championing. And I want to just thank everybody that's watching this, because really it's you guys. The response has been so great. Anthony, you've been leading the charge, and everybody that's watching here has been taking our article and reposting it and contacting people. I've had senators call me. It's really amazing. So, and big kudos to Steve Leisman. I blew up a Sunday night last night. We were on the phone 3 hours on a Zoom call, kind of taking it step by step. And he just texted me. I'll give you the update, the most up-to-the-minute news. He said he was watching the results from the 1030 operation. They only took 4.2 billion of the 9.1 submitted. So I said, okay, that's a start. And he says that's the lowest acceptance ratio since March 25th, which this is a big step. So hopefully the Fed is finally getting the message that they've got to take their foot off the neck of independent mortgage bankers and wholesalers for mortgage brokers, where they are literally choking us based upon these margin calls that are happening because the Fed thinks they're doing good and they keep buying mortgage bonds. It drives the price of mortgage-backed securities up. They think that rates are coming down. Because of capacity, you can't pass it on to the consumer.
Yep.
What's going on is that all of our locked pipeline, to protect our locks, you have to short a variation of mortgage-backed securities. So that means when mortgage bonds do well, your short position is getting killed. And while you should be making market gains on the transactions you're trying to close, there's broker-dealers you put these trades in for a hedge that are saying, I'm not going to wait. You got to give me my money and give it to me now. And I'm hearing 50 million, 30 million, 10 million. It's companies all over are really getting hurt. Now, I see mortgage bonds are up somewhat today. That's because traders are jumping in and saying, hey, I can't lose this trade. I got to buy mortgage bonds because the Fed is going to just keep buying and I'll make money on that trade. So they've created this problem. The Fed last week bought $250 billion. Now, I shouldn't say last week, over the last 2 weeks. Last week was 183 billion. But the supply that was coming to market was like 25 billion. So They're crowding everybody else out. They're driving the price up and they're creating these margin calls. So we're trying to, believe it or not, all of us, you guys that are listening, that have been sending that article out, been trying to educate the Fed. And thanks to the efforts of people like John Walden, who sent it out to 2 million readers, Peter Buchbar, and Steve Leisman, the Fed is getting the message. And this was the first signs that they have backed off their purchases. So thank goodness, I think thanks to all of us collectively, you guys, a huge part of that, all of you. And Anthony, you've been leading the charge, of course. We are finally getting the message across. So we may all, between us, save the mortgage and housing industry, because it's that serious.
Yeah, it's that critical. I'll tell you. I thought I saw MBS was up another on the Ginnie coupon was up another 30 or 40 basis points today. I don't know if that is that still accurate. But when we see these numbers, every single day that we see a 50 basis point improvement, it is literally requiring these independent mortgage bankers to send a check out the next day. And it's been every single day now for almost, I mean, we're going on a week or a little bit longer than a week. And it's crippling to people's balance sheets.
It is a really difficult time right now. So we just have to pray that that we can just cross this bridge. And really, that's what it is, Anthony. And I think that, you and I were talking before we started, as far as, what you're hearing and what I'm hearing, and completely understandably, there's some fear out there. I mean, shit, man, I'm fearful as well, as far as, people I love's health and things that are going on in the business world. And, So I'm not ashamed to say that there are times that I worry about this and I'm fearful about it. That's just a human response. So if all of you are feeling that way, I completely understand. But maybe there's ways to, between Anthony and I, we could talk about it a little bit today and unpack some of this where there truly may not be a reason for fear, that during these times there could be opportunities that come out of it. So maybe we could just take a look at this from a point of view of a long-term opportunity and what can we do.
Yeah, I think that's a great point because with all this fear that is going on, the reality is that it is a short-term situation. Margin calls, when these loans close, the lenders do get their money back, and this will work itself out, hopefully in the near future, next couple of weeks. So let's talk about that. What are the things that we can be doing in the market? What are the things that we can proactively start taking some initiative on?
So the questions that I get asked all the time are regarding what does the real estate market look like? And is this a good time to buy a home? And what does the stock market look like? And where will we go from here? And what are some of the things that we could do? So I will give you my personal opinion. It's based upon talking to a lot of people and based upon experience. So let's just start with the real estate market. So before we entered this, the real estate market was extremely strong. And if you take a look at today's numbers, which reflect a different world because it's from February, pending home sales were on fire. And every metric tells us that the housing market entering this was extraordinarily strong. Now, if you view this not as a complete devastation, and if you view this as a bridge that we have to cross, the other side of the bridge starts to look so much better. And while you can probably get a purchase on a home today to the extent that you can do it, I am not being insensitive. I know that it's difficult, but to the extent that you can go through with a purchase today, I think you'll look back on it and say, holy cow, I really did well with that purchase. And that's the message I want us to make sure we get out to our clients that are considering purchasing a home right now, because I feel there is enormous opportunity. Sellers are dropping prices on listings. Things have just gone on sale in the housing market, and they shouldn't, because in a market that, look, we're going to come out of this. It's going to be normalized. Our job is to see the future before it becomes obvious. Our job is to see past. If you're driving at night and you're driving down the road and it's dark, you only see what the headlights can shine on. That's all you could see. But we have confidence as we're driving that there's more road ahead of us, but we just can't see it.
Yeah.
And that's the way we have to look at this. We have to look at this as, okay, we're in crisis mode. I get that. But we have to open up our minds and imagination to see past this crisis what changed. So we know that there's still going to be more household formations than there are completions. There's more demand than supply. The economy will come back. Yes, there'll be hiccups. But we see a housing market that for a very long time, and with extraordinarily low rates, because they're going to stay really low, will provide an incredible opportunity for home price appreciation. And I think that people that are looking to purchase a home in this market, if they can, or as they potentially are able to, will look back and be extraordinarily pleased that they were able to do so. This is a great opportunity in my mind in housing.
Yeah, I think that's a great point. I think what it comes down to when I hear you speak about this is it really comes down to having a long-term mindset. Is if you're buying a house, I think for the most part, people buy homes with a long-term mindset. And with that said, this is going to pass, whether it's 6 months, whether it's 12 months. The reality is that there is going to be, we're going to get through this, and there's going to be a lot of opportunity on the upside, both in the stock market and in the real estate market. In your perspective, if you are, if you are a consumer looking to buy a house, what advice would you give them today?
So the first thing is I would just want to expand on what you said, because what you said is 100% right, and it's a brilliant statement. See, if you were looking to buy a home today and sell it a month from now, well, I wouldn't say to buy a home right now. But that, as you mentioned, and as you very accurately pointed out, it's a long-term investment. The average, according to the National Association of Realtors, that people stay in a home is 10 years. So purchasing a home today in this unpleasant circumstance will result, I think, in you getting an enormous benefit and opportunity 2 years, 3 years, 5 years, and especially 10 years down the road. Let's remember some of the smartest minds in the world. Baron Rothschild, back in 1815, back when he was ready to become the richest man in the world, said, "You buy when there's blood in the streets." And then he went on to say, even if it's your own blood. But this point being that in times of turmoil, this is when you want to have that opportunity. We all know that Warren Buffett said to be greedy when others are fearful. That applies here. Sir John Templeton, one of my favorites, he said that you want to be a buyer on the most pessimistic day. And there's certainly a lot of pessimism right now, and that creates buying opportunities for people. So think about that. And the other area, Anthony, you mentioned, like, what would I be telling my clients today who are looking to purchase home? It's exactly that this is a long-term transaction, that we've got to look past the short term and look at that as the opportunity, like so many great investors do. That's what makes them great investors. It's looking past where everyone's panicking, staying calm, and making the right decisions to see the opportunity in the future. So exactly the points that you made, these things that we're discussing here, are what I would be telling my client, that over the long term, they will be extraordinarily pleased that they made this, because all the metrics are in the right position.
Now, think about like our partners. So, I think a lot of mortgage brokers and loan originators have been coming to me and saying, "Hey, Anthony, I appreciate your videos because I've been sharing them with my realtor partners, and they're not getting, the Mortgage 101 from, whether it's NAR or whoever they get their information from." So, as you think about real estate agents that are dealing with similar struggles right now because of, shelter in place and all these different things, and they don't have the same understanding of what's going on behind the scenes as loan officers do when it comes to the banking world, how would you kind of guide them as a partner?
Well, I tell you what, Anthony, you've been incredible. I don't know how you've been doing it, because you've been doing like several videos a day sometimes, and you've been staying out in front and trying to bring good people on. I'm honored that you choose me to come on and talk about this stuff, but you've been kind of really helping people understand the behind the scenes of this. So why not share some of that with your real estate agents?
Yeah.
I will tell you that, what we've tried to do at MBS Highway is understand that this is a lot bigger than we are. So we've been putting stuff out for everybody, and our members understand that too, that this is a time where we have to educate. Now, within MBS Highway, we've got some great social media tools like Social Studio that people can utilize that will help you be that guiding light. So look, this is your chance to shine right now. If you're watching this and you're starting to put the pieces together, I want to tell you that it's okay if you don't have all of them put together. The best way to learn is by teaching. That's by far and away the best way to learn. So talk about this within your office, sharpen your skills, and then go on social media and you can discuss this, because people gravitate to you. Everybody wants to know what these opportunities are. There's a couple of other opportunities, Anthony, that I'd like to discuss with you if you'd like to go.
Please, that would be great.
So many people ask me about the stock market, and they're like, okay, Barry, is this a good time to buy stocks? And I hear a lot, should I sell stocks? Yep. And we've made some good calls on the marketplace as far as giving some levels. And Anthony, privately, you and I, we've gone back and I've kind of shared with you what I've been doing. I think we have a reasonable understanding of where things are. But what my feeling is that, and this is by no means, bank on this, but I think that there probably is a little bit more downside in the stock market. So if you wanted to try and get the most opportune bottom, it's my humble opinion, and I could 100% be wrong, but I don't think we've seen that bottom as of yet. I think there's too much uncertainty. See, what you want to do as an investor is you want to be able to model things. So you got to kind of be able to put a stake in the ground and say, okay, here's my starting point. Here's what I think we're going to have for a time period of a hit to the housing market, what we're going to be doing as far as the economy. And then I can model this out as far as the stock market goes. It's really, really hard with the variable of this coronavirus, as we've discussed further. As we discussed in the past, Anthony, you and I talked about this, and I think I came on with you and I told you how this virus was beginning to double. And when we had 5,000 cases here in the U.S., I told you where we were going to go, and we're pretty much dead on it. And now we're bordering on just an incredible amount of cases in the U.S. Until that slows down, I think it's going to be very, very difficult for the stock market to sustain a rally. It might have a short-term rally, but a sustained rally would be hard. We need some really good news there. Now, I could be wrong, but even if I am wrong, and even if the stock market does move up from here, I think people will look back at this point in time, again, on the long run as a good opportunity. If your time horizon is 3, 4, 5 years, if this is money for your kids' college, for your retirement, or for 5 years from now, whatever, I think you'd be doing yourself pretty well by considering thinking about taking some of your assets and putting them into equities that you believe in that are on sale right now.
Yep.
That said, please speak to your advisor and talk to somebody that you trust. But I think that you'll reflect on this time as wow, that would have been a great time to buy.
Actually, great point. Today at 2:00, for everybody that's watching, we're going to have Keith Nickel, who's a financial advisor from Northwestern Mutual, talking specifically about what Barry's talking about, which is, making sure you have a strategy in this market, because, whether it's the bottom or not, or if we're within 20% of a bottom or 10% of whatever this bottom is, there are opportunities, plain and simple. There's stocks today that are massively discounted. Even if they keep going down long term, they're still going to be, going up. They're sound companies with great business models.
So some levels to look for. Now, we did come down, in the range of a little bit above 2,200 on the S&P, and that's the only thing you want to look at as far as stock market goes. That's what your barometer should be, is just the S&P 500. I know the Dow gets a lot of headlines, but really the stock market is the S&P 500. And if you take a look at previous periods of time, some numbers for you. Now, we came down about 35% during this drawdown. During normal times without a recession, that's about right. But we are going to be in a recession. And during recessions, it is not uncommon to be in the 50% decline range. Now, that might be a little bit crazy, because that would suggest around a 1,700 S&P. I think if we get back down to about 2,200, which normally happens. You set a bottom, kind of goes up, vacillates, but you usually, not always, but almost always, you test that bottom in the neighborhood of 2,200. That would potentially be a phenomenal entry point. Now, could we go down to 1,800? 1,810 is a number that I'm looking at, or maybe lower. It really depends on how long this lasts, but I think this would be a great opportunity.
So, Barry, when you think about, this week, I think Friday is the unemployment or the jobless claims is coming out. That's 8 a.m. on Friday. That's going to be a big report this week. Obviously, last week we saw the initial jobless claims at 3.3 million for the previous week. What are your thoughts on lock strategy? What brokers or loan originators are doing for their clients leading into that?
So I think that the numbers will be ugly, because now remember, you're going to start looking at more continuing claims, because we're going to get a big jump in initial claims, a big jump in initial claims, a big jump in each week for the next few weeks as people unfortunately get let go. But eventually that will subside, and people, because when you get that number every Thursday, that's initial jobless claims, meaning people filed for unemployment benefits for the first time, so they were just let go. Once you file for unemployment claims the first time, then you can't do a first time again. You stay on. Why you transfer your focus to something called continuing claims. And that number will remain elevated, in my opinion, especially since looks like the government, in an effort to try and help, wants to extend it from 26 to 39 weeks, but they're also adding income. And Anthony, here is my fear. My fear is, and I know that people for the most part are very well intended, but I just wonder if somebody might say, well, I don't know if I'm in a rush to get back to work, because I'm actually potentially making more than if I were working without working. I could do this for 9 months. And I know that there's a negative side to that, but there might also be a fear to say, do I really want to rush back and be one of the first people back to work when I could stay on unemployment, given the health risks that might exist as well? So there are so many moving parts to this. And what might happen is we're all like caged animals, right? Yep. I mean, we're all going stir crazy. So hope to God that we get to some degree of safely getting back to normal. But I believe that there'll be a spike as people are anxious to do this in demand. But I think that the supply side will have a difficult time matching that demand. And that could cause some interruptions in price stability. You could have a spike up in prices or inflation or shortages. I think it's going to be interesting to see how this plays out. It'll be rocky. And a lot of these things that the government wants to do that are all well-intended may have some side effects or consequences that will be interesting to see how they unfold.
Yeah, I definitely, our team here at AIME, we spent a lot of time last week on the phone with leaders of default mitigation of really the servicing departments that are going to be fielding the forbearance calls. And it was a really eye-opening, these calls have been very eye-opening, because we've learned, sort of the disconnect between what's being communicated from the political side of things, from, governors and even the administration, to what is actually the reality of the situation, which is, hey, I'm going to go into a forbearance, I apply for it. I get a 3-month forbearance or a 6-month forbearance. But at the end of that 3 to 6 months, even though I haven't made a payment, they're not going to mark me late on my credit. At the end of 6 months, you have to pay all of those payments at one time. And the problem that causes is it kind of sets a lot of people up for failure and eventually credit risk.
So smart. Yes.
And that's an unintended consequence. So like, to me, I think that's why being an expert is so important right now is people are making short-term decisions that are uninformed, and more now than ever, the mortgage expert is so important.
So Anthony, and one of the things, forgive me, I didn't do was you asked me about what we see rates doing. So the challenge in that is that, you can look at what the market's doing and where rates should be, and then there's where rates are published, right, to the consumer. And under normal circumstances, for a very long time, since we all have been doing this, they have been very intertwined and beautifully connected. But because of capacity issues now, and the desire to slow things down, not just for capacity, but because of margin calls and because of
BPOs,
and even because of all of this, we are seeing a disconnect in what the market says rate. Based upon where the market is right now, 30-year fixed rate should be roughly 2.5% with 0 points. That's where the market is if you look at the charts and if you look at mortgage-backed securities. But because of capacity, because of shelter in place and people working from home, and because it's difficult for appraisers to get into all of the, you guys know the headaches more than I do. Okay, there's lots of disruption in what would normally happen, and then look, you get somebody all the way through the process, and then you send out a VOE, and you find out that they're one of the unlucky ones who were let go. That's got to be heartbreaking, obviously, for the consumer, but heartbreaking for you guys who are doing all this work and finally get them to the finish line. So the heartburn and stress that you're under is tremendous. What I'm telling you is that short term, it is very difficult to forecast what a company's response will be to where the market is and what the published rate would be. So that we cannot do, because that'll be a difficult game to handicap. And even within a company, that could change rapidly. However, again, if we focus on the bridge on the other side of it, I mean, shit, rates are going to be phenomenal. Yeah. Phenomenal. You will have our biggest problem is how are we going to handle all this business? And one of the things that I want people to focus on right now, and Anthony, you and I have talked about this, and that is what people desperately need. What I think your duty is to do is do cash out debt consolidation refinances right now. Everybody's got equity. And to the extent that you can do these, the real estate purchase side is certainly more challenged, but there's no reason why you can't help every family and say, I know these are tough times. Let me drop your monthly payment by $1,200, $1,800 a month, wipe out all your debts, and then give you an extra cushion. God forbid, should something bad happen, let me take some cash so you got some cash to sit on. And then once this is over, once we cross this bridge and we get to a more normal life, then that additional savings, let me show you what it will do when you put that back into accelerated payments. You take the cash and you put it back in your mortgage, or maybe you make an investment. These are things that people could be doing to literally change their life right now. And I mean, Anthony, you and I have talked about this with an MBS, how we've got an unbelievable debt consolidation tool that makes this easy and visually pleasing, and really analyzes it and gives you more data based upon where you are and what the home values are worth and all that stuff that shows it. But if you use it, great. If you don't use it, that's the focus right now. Do debt consolidation.
So as you know, and it's so true. The tools that you have make it very easy for a loan originator to present it both to their realtor partners and to consumers. I think that's one of the challenges that I've been trying to get loan originators to be more engaged with, is understanding that just like Barry Habib has an audience of the industry essentially that is looking to him to explain what's going on with MBS and what's going on in the market. Consumers in your market, real estate agents are looking at loan originators to explain what's going on. And there's such an incredible opportunity for people to be putting out content about debt consolidation and about, realistically over the next 5 to 6 years, your average consumer, whether they have kids that are going to go to college, whether they're going to do a cash out refinance for a pool or home renovation, now's the time to proactively say, hey, if you were ever going to get ready for it, now's the time to cash in on these low rates.
You couldn't be more correct. And let me tell you what we hear every single day. There are people that are using the scripts that we have and using these ideas. They're going out on social media and they put them out on Social Studio with us, and what they are discovering and what they, every day we're getting so many people say to us, you know what? I put this out there and I've got people that are listening. And even if it doesn't apply to them, they're sending it to others and saying, hey, I know you need this. My sister needs this or whatever. People are scared right now. They're scared if their job is going to hold on because maybe they're at home and they know, people know that business is slow and they don't know if they're going to get let go. So they need this lifeline that you can provide. You can provide a lifeline by giving them cash. Now, remember, if it's trapped in their home and they lose their job, they can't get it.
Yeah.
So and maybe they don't have as much in the bank. And maybe with the stock market down to these terribly low levels, they don't want to sell at the worst time and liquidate their stocks. And then 6 months later say, what did I do?
Yep.
I sold at half the value. You can provide a lifeline and they need you to do this. So why not provide that lifeline, pull some cash out. And if you reduce their monthly debts, I mean, the government's going to give people $1,200 one time. You could give somebody $1,500 every single month in savings by wiping out their debts and preserve their credit. Team, this is what we need to be doing.
So Barry, on that note, as a loan originator, if you were to say, call to action this week, let's forget all the things we don't control, which is, the market, margin call, all the things lenders are dealing with. But loan originators, we deal with consumers and we deal with real estate agents. We'll give them some action items of things that they can be doing, whether it's database management, social media post, give them some guidance.
So I know in this case, because the people that are viewing this right now, you guys are great. You care. You care about this business. You care about your career. You're what's really, really, really good about this business. And God bless you and thank you for what you're doing. So when I say this, I understand you're already doing it. But the first thing is to educate yourself, is to learn as much as you can so that you feel you have an expertise. However, take it a little bit further if you haven't done so already. Don't just internalize it. Talk about it with your teammates, because as you discover by just talking about it, you'll feel, where's the hole? Where's the thing I don't really understand? I got to go back and research that a little bit more. I got to listen to that one more time. And then you'll discover that you'll start speaking kind of fluently in a really short period of time. I'm not talking months. I'm talking a couple of days of discussing this. A very dear friend of mine has become Tony Robbins. He tells me when he first started, he used to give presentations 6 times a day because that's the best. If there was one person, he would give it to one person because that's how he got better. And what you have to do is practice and incorporate this into your dialogue all the time, and you'll become more fluent in it. Then go on social media. And what I want you to do is start to put this out in bite-sized chunks. You don't have to tell about everything. Small, bite-sized pieces, keep it to a minute or so, but give people an understanding that you're the go-to person. And then as they come to you, discuss things like debt consolidation. And then on a personal note, your call to action is look around for those opportunities that exist. Look at what is definitely has to come back when we get on the other side of the bridge. And you think about those things and you say, this can't stay down. This has to come back because it's essential, because we need it, but it's on sale right now. Maybe that's a time for you to take advantage of that for your own personal financial health into the future.
So with that said, Barry, going into, I see a lot of questions here about this week specifically. If you're a loan officer, are you advising people to lock in rates if they have a client that's, ready to move forward, or are you floating a little bit longer?
So as we've been telling our clients right now to float, Anthony, and that's because when we are looking at the market, at least for now, it doesn't seem to have the impetus that mortgage-backed security pricing will drive rates higher due to the fact that mortgage bonds are being gobbled up more than at a greater pace than supply is coming to the market. However, I tell you that I do not have the knowledge of how a specific company must, for their own good, respond in the rates that they put out. And please, team, please, a wholesaler, a company, whatever it is, this is the time to be extremely supportive of them. Don't think that if they're doing something that they're trying to do something that's not right. They want to make sure that they can survive to protect the business for you into the future. So please just be as supportive as you can of your wholesale lenders and whoever's listening to this. Any lender that you are, please try and be as supportive as you can.
Yeah, I think that's a great point, because I've been doing a weekly call with CEOs from both retail lenders and wholesale lenders, and these are some of the biggest lenders in the country. And the pain points are not channel specific. The entire industry is feeling the same exact pain point. Doesn't matter if you're a retail or broker. The margin calls have impacted everybody. Their servicing values being reevaluated has impacted everybody. Like everybody's sort of in the same bucket right now. And it's really just a matter of how they're communicating it to their teams. Some did it faster and some are, a little bit later to the game on the communication part of it. But I think overall, the biggest thing is understanding that this is happening to everybody. And the best thing that we could do as whether you're an employee or a broker to a wholesale lender is be understanding that these changes are not changes they necessarily want to make, but they're changes they have to make to persevere and get through this period in time.
I couldn't agree more. This is a critical time for us, and the messaging that we have to give to our real estate agents is one of hope too, because I can't tell you how many real estate agents they hit me on Facebook or Messenger or whatever, or email me, because a lot of this stuff, just like you, Anthony, I'm sure you're getting tons of people that are contacting you because of the information that we're putting out, and they're literally afraid. I have more than 30 or so conversations that I've had recently where you have to really talk people off the ledge. They're crying on the other end of the phone because they're fearful, and they need to understand that for most of us, it's hard again to see beyond the headlights. You have to bring them to the other side of this equation. We're going to be in a market that's really strong. This is not devastation. This is a bridge we have to cross, and we will cross this thing. It's just ugly to get there. And I know that, normally, I mean, when you look in the rearview mirror, sometimes you say, oh my gosh, has it been a year already? Has it been, was that, 2 months? And time seems to evaporate.
Yep.
But as we go through this, it seems like it will be an eternity to get through the month of April, right? I mean, it really does. But we will get through it. We will get through this, and it will pass, and then we'll look back upon it, and this will be the time where really you can be a hero. You can really shine.
Yeah, I think what the call that I had this morning with somebody in capital markets, something that we both respect, this person said, I think one of the things that's going to be amazing is loan originators are getting a mortgage 101 in capital markets like no other, and that's going to be good for everybody long term. And then B, the other thing is the truth of the matter is the Fed and the Treasury Department and MBA, everybody they know the problems. They're communicating the problems. And as fast as they're communicating the problems and identifying what the pain points are for mortgage bankers, they're coming out with solutions. So last week, at the end of the week, we saw Ginnie Mae come out with a facility to help mortgage bankers, with payments, default payments on P&I for Ginnie Mae loans that go into default. That's one step. Obviously, all these other things that we're talking about are problems that, will be addressed one way or another. I think it's very clear the Fed and the Treasury Department are not looking to allow any bankers, go out of business. I mean, it's really just a matter of them, being able to bring that solution to the market.
Well, again, Anthony, thanks to all of our collective efforts, the Fed now knows. And thanks to people like John Walden and Peter Bookvar and Steve Leisman, in taking our messages and the things that I put out there and getting it in front of the right people, the Fed's responding. And the first signs of it are this morning. And Anthony, we got on this morning. We know mortgage bonds were up, and this morning they were up like 56 points. They're only up 14 basis points right now. And, it seems crazy that we're rooting for mortgage bonds to not go up, but that's what we all collectively need to be rooting for right now. Mortgage bonds, please don't go up. And to the extent where you can even avoid a lock, I don't want you to jeopardize your customer, but to the extent that you could avoid a lock, put it off so that your company does not have to take on additional hedging exposure and risk in this market. Look, for the collective good of all of us. And if you're unfamiliar with why, please read the articles that we've put out. We put it out there for everyone. You can just go to either the MBS Highway page on Facebook, the public page, not the internal page, and also on MBS Highway's site, mbshighway.com. Right on the front, you could access it. We put it out there for everyone, not just for our members. And last night, we did put out something as well. We put out a special report, Anthony, that if you'd like to share with everyone, that breaks down the chronology of what went wrong. And we talk about, what the Fed, it's palpable in this explanation. It's what convinced Steve Leisman to go on air this morning and talk about it. Because when I walked him through, his response was, holy shit.
Yeah, that's everybody's response.
Yeah, because no one understands it. And the better we all understand, so watch that. And
I'll share that in the group for everybody, because I watched it. It really is a powerful video.
Yeah. So if we can understand it ourselves and get the message out, it really helps us to explain it.
Yeah, I think the most important things that I'm taking away from Barry's comments there was, number one, understanding that every time you lock a loan, whether that loan's going to close or not. I mean, at the end of the day, let's just assume every loan's going to close. Every single time you see on MBS Highway that the MBS has improved by 30, 40, 50 basis points, just understand that across your company's entire pipeline, they are now having to allocate real cash, not fake money, and they're going to have to put that with their broker dealer. And again, that money will come back assuming those loans close, but short term, massive cash crunch. And then the next thing is being understanding of, if you do lock a loan and you do take that position, like if the customer tells you that the VOE, that they lost their job, the faster you can communicate that to your company so they can terminate that hedge position, even though they're going to take a loss, at least they're not going to have that loan in their pipeline for 30 days or 45 days. It's very important that you were communicative. Like, nobody's going to get fired because they communicate the truth earlier. It's just a matter of, doing what's right for your company. So I don't know what individual companies are doing to help communicate these things, because nobody wants to spread, this positioning of weakness. But at the same time, it's important that we're helping originators proactively do these things.
And Anthony, I want to also just the people in our industry are so freaking awesome. They're so great. I mean, you know what? We compete against each other, and that's all fair and good. But the way that everyone has come together and the amount of love that we're showing for each other here is so freaking great. I love it. And it just shows the character that people have.
True.
But there are some people that I just want to tell you have been, behind the scenes doing such amazing things. People like Casey Crawford and Kevin Perennial, who you've had on, and Gary Malice. And there's so many. It's hard. Rick Floyd and one after another. Oh, Steve Jacobson and Sarah Middleton. These people are the folks over at Churchill, Sam Royer. All of these folks are sending letters to people in Congress. And I've spoken to certain senators last week that they are doing the very best they can. I mean, this is tireless work that a lot of these people are doing that all go behind the scenes, and we're lucky that we've got such smart people that we're all fighting this together. This is a fight we're all in on the same side. We're not competing. We are fighting together.
Yeah.
And completely united as an industry. It's wonderful to see.
Yeah, it's true. I'm on a text thread right now with some of the people you just mentioned. Everybody's contributing, and honestly, whether it's getting virtual e-closing legislation support, whether it's getting MBS support from the Treasury Department, like, it is collective and it's across the board. And Barry, you've done obviously an amazing job, because to be honest with you, you've sounded the alarm on a lot of things that might not have risen to this level of like Steve Gleason, covering it on CNBC for a couple more weeks. And you've been able to get this to the market very, very quickly.
Well, we're all just trying to do what we can do, man. But thank you for that. But we're all trying to do what we could do. You guys are on the front lines. I do want to say that for everybody watching, we are doing an alert to lock here. So I just want to let you know that, because it appears for a very good reason that the market has now deteriorated on mortgage-backed securities. Thank God it has, but putting us in a position where if we need to protect our customers, you should be doing that. I just want you to know that we just issued an alert to lock here internally. So I'm putting it out there for everybody, just so you know, because this is something that mortgage bonds are all the way down to just being up 8 basis points right now. And that's a big change from when it was up over 50 basis points earlier.
And that's, I mean, so going to what Barry's been preaching for the last week, and the reason why his efforts with Steve Gleason and some of these other media outlets is so important is, as MBS rises, as we know, of course, everybody wants rates long-term to be low. We all do well, but short-term, it's causing a lot of pain for mortgage bankers on their margin calls. MBS coming back right now and being nearly zero versus it was up 40 basis points today, even though bad for rates. So lock in your rates today. Very, very good for anybody that's on the wrong side of a margin call. So hopefully that provides relief to independent mortgage bankers. And like we said before, we're going to get through these next 2 weeks with the whole margin call issue. The loans are going to close. They're going to get out of this being vulnerable position, and then we'll get back to normalcy.
Should we take 3 minutes to explain why we want
Yes,
Mortgage bonds to go down. Okay, so team, here's what everybody is suffering through in the independent mortgage banking world. You know, wholesalers that brokers go to and retail mortgage lenders. We're all in the same boat here together. So if you were to lock somebody, we'll just pick a number here. You want to lock somebody at 4%. You don't really lock them. It's a promise to lock them. So your company promises to deliver 4%. But as the market fluctuates in between, your company's on the hook. So if rates were to go up because mortgage bond pricing went down, they have to pay the difference to buy that rate back to 4%. So if it went to 4.25 or 4.5, they've got to buy it down to 4 at the closing table. So because they don't want to be in a position of gambling, the way that they protect themselves is by doing something called hedging. And what that means is that they have to figure out a way that when mortgage rates rise, because mortgage-backed securities are going down, how can I make money on a trade that allows me to make money in that circumstance? So when mortgage bonds go down, if they short mortgage bonds, meaning they sell them in advance and buy them in the future, then they profit from the decline in mortgage bonds. And what that does is it offsets beautifully, it pairs off the amount that they gain in their trade, in their hedge, gives them enough money to buy the rate from 4.25 or 4.5 down to the rate that they promised at 4. And that works great. It gets tricky on the way down in rates because it should work exactly the same. So I've got a 4% rate and it's gone down to 3.5. I'm going to make more money on that delivery giving the customer 4. However, because I protected myself, my hedge position now, because I shorted it, now is losing all kinds of money. It's kind of like if you shorted Apple at, let's say, $300 and it goes to $400 because it's going up, just like in this case, mortgage bonds go up, which make rates come down, you're losing money on that. So the amount that you've lost on that short trade is offset by the gain that you made in the market at 3.5 on a 4% promise. Yep. Pairs off, beautiful. Yeah, but the broker dealers put a collar on that. If it gets too crazy, if mortgage bonds go up too much, my short position is losing money too much, too quickly before I can close the loans. On paper, I'm even. But the broker dealer says, you have to give me my money right now. And that's what companies are doing. They're writing these checks for 50 million, 30 million. Thank God they're smart. Thank God they're well capitalized. But there's only so much of this pain you could take before it really. Some people have told me they're on the edge this week.
Yeah, I've heard that as well.
That's why this was such a cry for help from all of us. And thank God mortgage bonds now are only up 2, was up 50. And I have to tell you, I think that this is in part to all the effort that you guys are doing. And it's in part to people like Steve Leisman and Peter Bookbar and John Wall to get it in the right hands. I think that the work that you're doing, and thank you for doing it, is really having an impact.
Yeah, I hope this is sustained, because if we, to your point, we're going to have the ability to make money and close refinances and do all that, the good stuff long term. But the next 2 weeks are critical for many of these people. And just understand that there is a combination of issues right now that independents are dealing with. Like, for example, India just closed down. A lot of independent mortgage bankers rely on offshore, contract underwriting, all these things. And that's slowing fulfillment. That's also slowing lenders from being able to get loans off their warehouse line and sell those loans. So, now they're holding loans for longer. They have more business than they can handle. So operationally, they're taking more time. And then we have this compounding effect of margin calls that has been going on. And every day that loan doesn't close, their cash outlay is bigger. So, right now, this is going to be one of the rare times that everybody's rooting for the MBS to not go in the favor of rates. But at the same time, it's in the best interest of really the whole industry.
And by the way, it's not forever.
Yeah.
Take your foot off the gas for 2 weeks, because it's really not on what the Fed needs to understand. It's not on the gas. It's on the neck of every mortgage banker out there. They've got their foot on the throat and they're choking every mortgage banker out there. And they just got to let up for a couple of weeks, let loans clear out, let these margin positions square off, and then you could start buying. But don't buy like the bazooka. In my video, you saw, Anthony, they went from buying $6 billion, $4 billion, which is a lot, to buying $40 billion a day. That's freaking ridiculous. There was only $4 billion coming to market. They're buying $40 billion. That's creating an imbalance.
Yeah.
They're crowding everybody else out of the market, and they're causing speculators to come in and say, oh, I got to buy this because the Fed's my put. The Fed's behind me, and they're going to push. So greedy people wisely are making a ton of profit on this. And that combination is hurting. So if the Fed backs off, the speculators back off, the market settles, we close these deals. I'm not saying we want rates to go up through the roof, but just stop the bond market from causing this pain for a short period of time, 2-3 weeks, then go back and buy up all you want.
Yeah, April 15th and after will be, hopefully we'll be past this, and nobody will be hearing the word margin call, the term margin call, for quite some time. Barry, we had you here for 48 minutes. We appreciate your time. The community, obviously, there's a lot of engagement here. As we mentioned before, guys, MBS Highway is a tool that I know most of you are already using. If you're not, please, we'll include the link.
There's a special deal with you guys too. There's a special deal that Anthony's put together for you guys. So just send an email our way.
We'll share the link to sign up through the AIME discount in the comments so everybody can find that. And Barry, I will also share that breaking news, that special report that you did yesterday, because that's definitely something. If you want to know what's going on, that's a must watch.
Thanks, man. You be well, and thank you, and all of you, please stay healthy, stay well, you and your families.
Thank you, Barry. We appreciate you. You have a great day, and keep up the great work.
Thanks, man.
Thank you.